Now let's talk about the accounting when we sell and issue some stock. Starting with issuing par value stock. Now remember, par value is going to be the minimum amount required in order to buy the stock, because that's the stated amount on the stock. And so the par value is going to be the absolute minimum that somebody is going to be able to buy this stock for. So when we issue par value stock or issue stock at par value, we're going to have this journal entry here. It's going to be cash coming in. So in this case, they issued 30,000 shares of $10 par value stock. So they collected $300,000 cash. Cash coming in for $300,000. So we're going to debit cash, and we're going to credit common stock with a $10 par value. It's pretty straightforward. That's exactly what happened here. We collected cash. We issued our $10 par value stock. And so there's going to be our entry. Now, if we were to sell that $10 par value stock for $12, because the par value is just the minimum required, and you could be, or these stocks could be worth more. So in this case here, we sold those same stocks, but at $12 a piece. So they issue their $10 par value stock at $12 per share. And so it's sold at a $2 premium. So now we have $360,000 coming in, because that's the 30,000 shares times $12 a piece. So $360,000 of cash coming in. So we're going to debit our cash account for the $360,000. We're still going to credit our common stock with a $10 par value for the $300,000. But now we're going to have this paid in capital in excess of par value, or sometimes it's APIC, additional paid in capital. So paid in capital in excess of par value of common stock for $60,000. So we're going to keep our common stock account at that $300,000, because that is going to be recording the par value of the stock. And then we're going to have this additional account, this paid in capital in excess of par value account, that's going to keep track of just that, what was paid in excess, what the premium was on the shares that we sold. And so on the balance sheet, that account is also going to be in equity. So on the balance sheet, you can see here's our common stock with a $10 par value. And then on the financials, it most of the time always says how many shares are authorized. So 50,000 shares authorized, 30,000 shares issued and outstanding. So the company is authorized to sell 50,000 shares, but they've only sold 30. So they can issue another 20,000 shares if they need to raise more capital. But right now there's 30,000 shares outstanding. So common stock is 300,000. Paid in capital is going to be that 60,000, and then the retained earnings. So that paid in capital in excess of par is going to be in the equity account with the common stock. They're going to be right next to each other all the time. Now, when we're issuing no par value stock, so there is no minimum requirement in order to buy this stock, then we don't have a common stock with a $10 par where it states the amount of what the par value is. So we would just have cash and common stock with no par value. So whatever we sell it for is going to go to that common stock account, because there is no par value. There is no paid in capital in excess of par. There is no par. So here we issue 1,000 shares of no par common stock for $40 each. $40 each. So that'd be $40,000 in cash coming in. We would debit our cash for $40,000, and then we would credit our common stock with no par value for that $40,000. Now, when we issue stated value stock, it's going to be very similar to that paid in excess. So we have 1,000 shares of no par common stock that has a stated value of $40 per share, and they sold it for $50 per share. So they collected $50,000 in cash. They collected $50 per share. They sold 1,000 shares. So cash for $50,000 came in. So debit our cash for $50,000. So we have common stock with a $40 stated value. So we would have our $40 per share. So that there is going to be $40,000. So we would credit that. and then we have this paid in capital in excess of stated value of the common stock. So again, very similar to up here, issuing par at a premium, but this is going to be when we issue it at more than its stated value. And so we would again have this paid in capital in excess of. So cash came in for $50,000. The stated value on those shares was $40,000. So our paid in capital in excess of the stated value is going to be $10,000. And you can see here the text gives us a frequency of stock types. So most of the time companies issue stock with a par value. So that is what we see most of the time. But you can see that's 88% of the time the stocks that are issued are going to have a par value. 3% are going to have a stated value. And 9% of the time they're going to have a no par. So most of the time stocks that are issued are going to have a par value. Now, when we issue stocks for non-cash assets, which means we are not collecting cash, but we're collecting some other type of asset for the issuance of our stocks. So here you can see that it says they received land for $105,000. That's what it was valued at the time they received the land. They got land for $105,000. In return for 4,000 shares of $20 par value stock. So instead of receiving $105,000 in cash, they received land that has a value of $105,000 in exchange for that common stock. So very similar to what we were looking at when we're getting cash, except we're not getting cash, we're getting land. So we collected land, we received land, so debit land for $105,000. We have our common stock with a $20 par, so $20 per share, 4,000 shares, so there's $80,000 of par value that we are issuing. So we have our common stock $20 par value for $80,000. And then we have our paid in capital in excess of par value for the remaining $25,000. So again, it's very similar to cash, but instead of receiving cash, you received another type of asset, another asset. So it could be equipment, it could be land, it could be building, whatever it is, whatever you received, you still issued those shares. So there's still going to be the $4,000 or 4,000 shares issued with a $20 par value that were issued. And so you just need to take the value of the assets received at the time of receipt, and that is what you're going to be getting for the issuance of those shares. So again, we're going to debit land for $105. Our common stock with the $20 par value is going to be the 4,000 shares at $20 a piece. So par value of $80,000 was issued. And then we have our paid in capital in excess of par value for that $25,000. And so similar to receiving an asset, if the company were to pay expenses with the issuance of their common stock, it'll work kind of similar. So you can see here a corporation sometimes gives its shares of its stock to promoters in exchange for their work in organizing the corporation, which is recorded as organization expense. So it says the entry to issue 600 shares of $15 par value common stock for $12,000 of organizing work. So they're paying the expense of $12,000 by issuing shares. They're not going to give $10,000 or $12,000 in cash. They're going to say, we owe you $12,000. Let's just give you 600 of our shares because we're a startup company. We don't want to send out the cash right now, but we'll give you a piece of our company. So we're going to debit the expense account because that's what we're doing. We're settling the expense. So the expense account is going to be $12,000. We are going to be issuing our common stock at a $15 par value, 600 shares of that. So that's $9,000 is going to be the par value of the common stock that we're issuing for the work that was done. And then we have our paid in capital in excess of par value for the remaining $3,000. So again, that is when the stock is issued for work that is being done. So here we're receiving an asset in exchange for our stock, and here we are settling an expense, or we're incurring an expense, and we're paying it with our stock. So you can see here that that this bottom, what we're crediting, is going to be the same across the board. Across all of these entries, it's always going to be the common stock account with the par value, with the exception of the no par stock. But we're always crediting our common stock, and we're always crediting our paid-in capital in excess of par. But here, what's different is going to be what we're debiting. What are we receiving for that stock? Are we receiving cash? Did we receive land? Did we receive equipment? Or did we incur an expense and we're settling it with, or settling the payment with this stock? So we have to remember that in accounting, we're kind of telling the story of what happened. So that there is issuing stock for non-cash assets.